Before I get into calculations, percentages, or qualification rules, I want to start with something I see all the time in my work. Not long ago, I spoke with a client who had spent years building real wealth. They had sold a business, invested carefully, and lived comfortably off savings and investments. From my perspective, they were a strong financial position and more than ready to buy their next home. But when they applied for a mortgage, everything had slowed to a screeching halt. Every lender asked the same question: where's your income? They were no longer working a traditional job. They were living off their investment accounts and savings by choice. Their tax returns showed very little income because they were managing their money strategically, not because they were struggling. In real life, they were thriving. On paper, they looked underqualified. That disconnect is exactly why I often introduce clients to the Asset Depletion Loan. Once I shifted the conversation away from paychecks and towards assets, everything changed. The numbers finally reflected reality, and the loan structure actually made sense for how they lived. Hi, I'm Kelly Arriaza, your mortgage and home loan expert with Nexa Mortgage. Today, I want to walk you through what an asset depletion loan really is, who I typically recommend it for, how it works behind the scenes, and how borrowers qualify using their assets instead of traditional income. Understand the basics of an asset depletion loan. When I explain this loan to clients for the first time, I always start with the big picture. An asset depletion loan allows borrowers to qualify for a mortgage using their liquid assets rather than employment income. Instead of asking for W-2s, pay stubs, or full tax returns, the lender looks at what you already have saved and invested. When the lender does is spread those assets out over a long period of time to calculate the monthly qualifying income. This process is called asset depletion. I always remind clients that this does not mean they are expected to drain their accounts or spend their money. It is a simple way for the lender to measure whether the asset could reasonably support the mortgage over time. These loans fall in the non-QM category, which just means they do not follow traditional documentation rules. In my experience, that flexibility is what makes them such a strong option for the right borrower, of course. Why asset depletion loans exist. I think this part is really important to understand. Traditional mortgage guidelines assume income comes from a job, but many of these clients I work with do not live that way. Retirees, investors, high net worth individuals often rely on saving, distributions, and portfolios rather than a paycheck. When underwriting only looks at a tax returns, those borrowers can appear weak, and they actually are. I see that frustration all the time. Asset depletion loans were created to fix that problem. Instead of asking how much you earn every month, the lender looks at whether your asset can reasonably support the mortgage long term. That shift is what allows the loan to line up with real financial life. Who benefits most from an asset depletion loan? When I look at my own client base, asset depletion loans tend to help a few groups especially well. I often recommend this option to retirees who live off investments rather than employment income. I also see it work extremely well for the high net worth individual who have substantial liquid assets but intentionally keep taxable income low. It can also be a strong solution for self-employed borrowers who have accumulated wealth over time and prefer to not rely on business income for qualifications. I've also helped clients who've received assets through divorce, settlements, or inheritance use this loan successfully. What all of these borrowers have in common is that their financial strength is real. It just does not show up neatly on a tax return. What assets can be used to qualify? When we get into the details, clients usually ask me what actually counts. Asset depletion loans focus on liquid and semi-liquid assets. That typically includes checking and savings accounts, brokerage accounts, stock, bond, and mutual funds. These are assets that are easy to verify and access. Retirement accounts like a 401k and an IRA can often be used as well, although lenders usually apply a discount to accounts for taxes and withdrawal rules. I walk clients through this carefully so there are no surprises. Trust funds may also be considered depending on the structure and the access. One thing I always point out is that any asset used for down payment and closing costs are subtracted before this calculation. Down payment expectations and equity requirements. Because this is a non-QM loan, equity plays a big role, and I make sure clients understand this up front. For a primary residence, many asset depletion programs start around 20% down. Some strong borrower profiles may qualify with 10%, but 20% is a safe planning number. Second homes often require 20% or maybe even up to 30%. Investment properties typically require 20 or 30% or more. This structure balances flexibility with responsible lending, reserve requirements, and post-closing liquidity. Another conversation I always have with clients is about reserves. Reserves are the amount of money you must have available after closing to cover a certain number of mortgage payments. For primary residents, this is often 6 to 12 months. Second homes may require 9 to 12 months. Investment properties may require more. Eligible reserves usually include the same type of liquid assets used to qualify. In many cases, the same assets can be used for income calculation and reserves depending on the lender. This is why planning and sequencing are so important. Credit score expectation. Even though income, asset-based credit still matters, most asset depletion programs look for minimum credit score around 620. In my experience, better pricing and flexibility usually begins at 680 to 700 and above. Lenders also look at the full credit picture, including payment history and overall behavior. Strong assets work best when paired with responsible credit management, purchase, refinance, and cash out options. One thing I really like about the asset depletion loans is their flexibility. These loans can be used to purchase a home, refinance an existing mortgage, or in many cases, take out cash out. For clients with significant equity and limited traditional income, a cash out refinance using asset depletion can be a powerful tool. It allows access to funds without relying on tax returns. That flexibility makes this loan useful at many different stages of life. Eligible property types. Asset depletion loans are also flexible when it comes to property types. Single-family homes, condos, townhomes, and properties with up to 4 units are commonly eligible. Second homes and investment properties are also allowed under many programs. This gives the borrowers more freedom to choose homes that fit their lifestyles. Why borrowers choose asset depletion loans? When clients ask me why they should consider this loan, my answer is simple. It's reality. Asset depletion loans do not punish smart financial decisions. They do not require borrowers to change how they manage their money just to qualify for a mortgage. Instead, they focus on real financial strength. Understanding the trade-offs. This is important. Of course, I always make sure clients understand the trade-offs of an asset depletion loan. It usually comes with slightly higher interest rates than a conventional loan. Sometimes the down payments and reserve requirements are higher. Documentations focus heavily on assets, but the borrowers who cannot qualify traditionally, despite strong finances, these trade-offs are often worth it. Strategic ways borrowers use asset depletion loans. Some of my clients use these loans as a bridge. They buy now and refinance later when income and structures change. Others keep the loan long-term because it aligns better with their lifestyle and tax planning. There's no single right strategy. My role is to help the client choose the one that fits their goals. Here's a bonus tip. Know your asset story before you apply. Before applying, I also encourage clients to really understand their assets. Know what is liquid, what is a retirement-based, and how much you plan to use for a down payment, and reserves. Clear organization makes the process smoother and less stressful. Working with someone who understands asset-based lending can make a huge difference. Now let's bring this all together. When I step back and I look at this loan as a whole, the value is clear. This is not a loophole or a shortcut. It is a modern solution for borrowers whose wealth does not come from a paycheck. Used correctly, it allows people to move forward confidently without forcing their finances into boxes that do not fit. If you have a strong asset but limited traditional income, I would love to help you explore whether an asset depletion loan makes sense for you. You can call or text me at 801-548-0162. You can also email me at kariaza@nexamortgage.com. You can also visit my website, kellyyourmortgageexpert.com. Schedule a free consultation. I'm Kelly Arriaza, your mortgage home loan expert with Nexa Mortgage. Thanks for watching, and remember, your mortgage should reflect your real financial strength. Let's make this process simple and align with your life.